Do you have your money in whole life and some in an IUL? There's no point in having an IUL without leverage. Whole life, I get the whole life thing because you get the guaranteed dividend and things like that. And there are some benefits of the death benefit play and things like that. But if you have an IUL, there's no reason to not leverage it.
I think where I'm concerned is it feels like it potentially could be built on a house of cards. What happens if the insurance company stops this? What happens if interest rates go down? What happens if and when the market doesn't perform? What happens when the company shuts down?
A good growth potential in S&P 500, what you need. But those two are not good enough. In a whole life, it's not good enough. IUL is not good enough. Real estate, it's not good enough. You have to include leverage. I know leverage gives you a little bit more risk.
Where are the places that this could unravel? And if they do, is it just going to perform worse or is it going to blow up in someone's face? Because we all know that there has been IUL that have, now this is more like 20 years ago, but have not just not performed, but have blown up. Life insurance is not an investment, and it very much feels like you're selling it like an investment. Do you ever worry that the insurance company or something in the contracts are not going to turn out the way that you think it is right now? Because that's my biggest concern, I think, with when I see your marketing.
We've been taught no risk, no reward. That to me is the single worst idea in all of retirement planning and personal finance.
Obviously, I'm not a believer in what you do. I just don't have a belief in this structure over 30 years because of insurance companies, because of all the factors that you and I can't control. My question to you is, you're a big fan, and I've seen videos of you say like, don't do real estate or don't do other things, like MPI is the one and only way. And anytime I hear that, I go like, oh, is that really, like, if everyone did that, who would be providing value in the world?
We've got to get to the point where let compound interest do all the heavy lifting, not you, because you can only work so hard. Compound interest can work 10 times harder than you.
Well, what's your definition of risk?
I lost $2 million in a single day, and it was devastating. I was making hundreds of thousands of dollars, some years millions of dollars, and I put every single dollar back in my business to buy a 100,000 square foot building and new CNC machines and 150 employees and all this stuff. And in a blink of an eye, it was all gone.
So but how is yours different? Because I'm getting the sense that you're buying more cash value, you're getting more indexing power, but you still have an outstanding loan. If insurance companies who are dying for our premiums, why are they not embracing this? Hey guys, this is Caleb Williams here, founder of BetterWealth. This is part 2 of a 2-part series that I'm doing on Curtis Ray, MPI, and the whole movement that is, involved in Curtis and what he's up to. And part 1, I shared, my heart behind this entire series. So if you've not watched part 1, I would highly encourage you to do so. It gives a lot of context. And I share why I've sat on this interview for, since 2022, since I did it. And the summary of that is I just didn't know if I wanted to promote this, put a spotlight on this. I didn't know if I wanted to be a channel that created drama. And so I sat on it, and I really was at peace to not publishing it. And then, as we've grown as a channel, I've shared things, people have said things on the podcast, and I just thought, you know what? And I think it's time. I think it's time to publish this. I believe our audience is at a level that they can do what they may. Know that I don't endorse people just by them coming on the show. You'll know that I don't agree with almost anybody across the board, and that's not the prerequisite of being on the BetterWealth show. I need to agree with you, but I'm hoping to have more conversation instead of less conversation. And so, which leads me to this interview with Curtis. It's the entire interview. And the reason it's the entire interview is I didn't want to doctor it in any way. When I reflected on the interview, part of me was like, man, I wish I would have been harder in some areas. Part of my nature is just like, I love people. I especially love talking to people that are passionate about what they do. It is one of the most life-giving things. And so there's many critiques that I have of this interview, but I felt like in full integrity, I needed to publish the entire episode for you to see. And you'll also see that I did push back. Even the 2 years ago, Caleb was pushing back. And I think some of the answers that Curtis gives will help fill in more of the gaps and maybe hopefully increase more conversation. I said this in the part 1 intro. My hope is to have more conversations. I would love nothing more to have Curtis back on, maybe include some other voices, including Rocky, in the conversation, and not do the whole name calling or anything, but just have discussion, and hopefully more conversation equals better outcomes. We stand with Better Wealth, we want to find a better way. And I know that sounds cliche, but part of the better way, I believe, is more conversation, not less conversation. So without further ado, here's my sit down conversation with Curtis Ray himself. Curtis Ray, welcome to the Better Wealth podcast.
How you doing, Caleb? Glad to be here.
I'm doing phenomenal. It is an honor to have you on. And the reason it's an honor to have you on is I think out of anybody in the insurance business, you have gone viral on TikTok multiple times. I'm wondering, first and foremost, have you been stopped by anyone that are like, hey, you're the guy that told me not to pay off my house? Like, how has TikTok changed your life and business? And like, did you get into TikTok on accident, or did you see that being like the next trend and did you want to jump on it?
Well, it's funny. It's because I was just in Florida and 3 different people in Florida stopped me randomly and said, "You're Curtis Ray from TikTok, right?" And I'm like, "Yeah, that's I'm that guy, right?" So it was March of last year that my social media guy came up to me and he says, "Hey, let's start a TikTok channel." And I'm like, "I don't dance. I don't sing. Why would I want to start a TikTok channel?" He's like, "No, trust me." And at that time, there was, I think, 40 million users. So it was a pretty smaller platform at the point. And we started making a lot of videos. I had my first viral video in about a month. It got 1 million views on why to start a compounding for a child as soon as possible. It could be the single most important decision you ever make for them. And then I started growing it. I got 10,000 followers, 20, 50,000 followers. And then I'm a big energy guy. I believe the universe blesses those who want to be blessed and those who believe they deserve it. I'm not a big idea that you have to always do everything right. You just have to believe that you're doing good things and then go out there and get it. And if you believe you deserve it, it just comes to you. And I'm doing this keynote speech in October of last year. And I tell these people, you just have to believe you deserve it. And then you got to go offer all your energy and your value to the world, and they're going to receive it. And if you have good products and you believe you deserve it, it's going to come. And within 1 week, I had 2 viral videos back to back. And I said, I told you guys, the universe just blesses me. And then I got up to 250,000 followers. Then I got verified. And that was a big moment. I was live on a TikTok live when I got verified. And it was like, I almost came to tears and stuff like that. It's kind of funny. Then I'm on a podcast with Hakeem Vyas, who's an NFL football player. And he goes, "How the heck did you get a TikTok channel about retirement planning to go viral? That's such a boring topic." And I go, "Because I told the universe I deserved it. And I offer good, awesome information and education. And watch, I'm going to show you it works again. I'm going to have 1 million followers by my birthday," which was 6 months. It was June 7th. And he goes, "That's impossible. Not going to happen." I go, "Nope, watch it happen." It took less than 1 week. In 1 week, I went from 250,000 followers to 1 million followers. He calls me back up and he goes, "Did you sell your soul to the devil?" I'm like, "No, I just told the universe, I believe I deserve it. And I truly believe I deserve it." And it came.
What's next for you on the social media space? I know that you've been focusing a lot on YouTube. You're still going heavy on TikTok. You've done documentaries. So you're very innovative on in the space. What are you looking for 2022?
Well, I created this whole online compound interest video series, and it's the first of its kind. There's never been a video series regarding the phenomenon of compound interest, how you maximize it and then apply it to your everyday life. And so we just launched it. It took us 7 months to build it at $250,000, and we offer it for free for the whole public. So it's like this big moment, but I come to realize that it's pretty in depth. Like, a lot of people get scared away by it, by understanding the mathematical side of it and then what you have to do to commit to it. And so we just created the mini series, which is the 25-minute version of the 2-hour version that is much more like hey, you can do it. You deserve this. This is how you get compound interest. It's not as hard as you think it is. Don't let the mathematical side scare you away, because all it takes is pay yourself first, put it somewhere that is growing, protect that money. Do not put yourself at risk, and then give it time. And if you can give those 4 little things, all of a sudden wealth is achievable by anyone. It doesn't matter if you make $30,000 a year or $200,000 a year. The phenomenon of compound interest is for every single person. So we're going to be launching that on all social platforms. You're going to see a lot of those webinars, like webinar goes live in 37 minutes, and it's playing
at 2 a.m. They're like, I don't know if that's a live webinar. Yeah.
Curtis is crazy, but maybe not even that crazy.
So it's interesting because I'm a big fan of compound interest, and what I don't add the protection piece, but that's a big piece, obviously. But it's interesting. It's like compound interest is not complicated. You need something to compound because 100% of 0 is 0. You need to give it time. And then what are the other things that you find that it's like people just don't get? Because I feel like at the end of the day, you feed the beast, it compounds, you don't lose money, which I guess is another way of protecting it, and you give it time. It's just an amazing thing. Is there like what gets people tripped up when it comes to the idea of compound interest?
The most important thing is commitment.
Yeah.
You've got to keep putting money into it. Like it's a lifestyle. My favorite book is The Richest Man in Babylon,
Yep.
and he goes
First
through a
book I read on money, by the way, and it changed
right.
my life as well.
I read it every single year. I highlight it. Every single time I read it, I'm like, I don't remember this part in the
Yep.
book. This is gold right here. But he says, pay yourself first. You've got to put money away, then live on the rest of your 90%.
Yep.
You save 10%, live on 90, and then put it somewhere that doesn't lose principal value. You've got to only invest in experts, the best guaranteed securities, collateralization. You've got to not put yourself at risk, because we've been taught no risk, no reward. That to me is the single worst idea in all of retirement planning and personal finance, is the idea that you have to put yourself at risk in order to get a reward. Think if someone came to you and said, in order to have the best health, you have to put your body at risk. You'd be like, shut up, you're an idiot. Or if someone says, if you want to have the best marriage, you have to put your marriage at risk. You're a terrible marriage counselor.
Yeah.
But money is so exciting. So we get tricked in this, got to put it at risk, got to go for broke, got to do all in. No. Slow and steady wins this race. And that's the hardest thing for me, is to convince someone that believe in 10 or 15 years from today. You do not need to get a home run today. You need to win singles and doubles over and over and over. And we'll get into life insurance, because you've already said you're a big proponent of life insurance, but we've got to get to the point where let compound interest do all the heavy lifting, not you, because you can only work so hard. Compound interest can work 10 times harder than you.
What's your definition of risk?
Risk is when you can lose principal value, where you can put yourself in a position where something can blow up and you start losing the actual money you earned, your money. You can put your money that the money makes at risk. That's, a lot of things. I'll talk about things like that. But when you start putting your principal value at extreme risk, and yeah, everything has a layer of risk. There's nothing that is riskless, but the goal is to minimize risk. And that's why I go real heavy on secure compound interest, because there's a clear difference between secure compound interest and risk-based compound interest, or what I call investments. They work together, but they're not the same thing.
Right. My favorite definition of risk is your chance of loss. And so only in America, it's increase your chance of loss and you'll have more money. It's like, well, right. I don't know how that translates, but maybe that's why everyone's broke in America. Okay. So one of the things I want to jump into is I don't know if you have any context of who I am or BetterWealth.
I've watched some of your videos. So obviously when we reached out, I did my own research to make sure I understand what I'm getting into, right?
Okay. Yeah. So one of the things is like I grew up I was the oldest of 6 kids. My dad was a PhD molecular biologist. My mom was a stay-at-home mom, so I was homeschooled. Very, very like thankful for my upbringing. Got a job at a bank when I was 17. Took over a bank's investment department when I was 19 years old, and then from there just learned a ton. And in that, I was a very big Dave Ramseyite. Read other books that I was just like, I always wanted to understand money, and then I realized like, okay, Dave's just an entertainer. He's sharing half truths. And it really like tainted me, but it helped me understand. Like I became very convicted on certain things like efficiencies, taxes, life insurance, and I really much felt like I was the biggest skeptic, and then became one of the biggest believers. I just, in full disclosure, our company sells whole life and IUL. I'm not one of those people that are just all in on one strategy, and I feel like life insurance is a powerful place to store capital. To save it for the future. I think the biggest difference between you and me is it sounds like, and I don't want to put words in your mouth, but it's very much of a savings. I don't know if you'd call it an investment vehicle on your end, but it's the strategy. I look at life insurance more as let's store it. Let's look at the power of life insurance, and let's utilize it as more of like an and asset. And it sounds from your research, and I've watched a lot of your videos, that for you it's for income. And we're using the HELOC method, and we can like look into that a little bit more. But one of my biggest concerns is like, do you ever worry that the insurance company or something in the contracts are not going to turn out the way that you think it is right now? Because that's my biggest concern. I think with when I see your marketing is, it sounds really good. You own compoundinterest.com, which congratulations, that's one of the best domains out there. I love everything about life insurance. I save over 6 figures a year into life insurance. I love compound interest. I get the definition of compound interest, but I also don't know 40 years from now if all of our assumptions are going to translate into what we think they are. And does that concern you at all, that all of this energy is going into this strategy built on some levers that could change? I mean, there's some assumptions that we're making, that I'm making, that you're making, that could change, and that is concerning. So that's where I just want to be upfront to be like that I don't know everything, but I know quite a bit, and that's probably the biggest difference between you and I. And I would love to talk about it because I don't know how many podcasts that you're on that of people that have this context, but I do not like people that are just like calling names or like, oh, this person's a scam and all this stuff without being willing to have a conversation. And so I commend you, but I also, this is unlike interviews I usually do because I don't like the being confrontational, and so I'm going to do my very best. But I very much want to learn and seek truth and hope to give people clarity as they're doing their research, because people are researching our strategies and they're researching your strategies, and I think episodes like this are vital.
Yeah, and I'm a believer in embrace all good.
Yep.
So when you see something good, you embrace it. And I do struggle with financial advisors and other life insurance agents that they go, oh, MPI is a scam. It says it's better than me. It must be a scam. It's like, you don't really know anything we do. So there are some assumptions we make. The good thing we have is we have 100 years of research and data that allows us to predict the probability of success. Nothing is 100%, but what is the probability that this succeeds over an indexed fund or, Roth IRA built in traditional stocks or ETFs or even whole life or things like that, or even the regular IUL. Like I only think the regular IUL is average at best. Whole life is average at best. 401ks are average at best. But when you start combining all their simple features that make them good into one direction, that is what I believe MPI is. It's the combination of what is the best of real estate, leverage. What is the best of a 401k IRA, the stock market? What is the best of insurance, security? If you can get all three of them in a single platform, that is what I call the triple advantage of compound interest: security, growth, and leverage. And so when they go, oh, well, what is the probability that MPI is going to work? Well, if we go in the last 100 years of research and data, it had a 100% probability. Yes, there are things we can't control in the future. I guess I want to ask you the simple question. Do you understand how an IUL actually makes money? Yep. Like where the money goes through?
Yes. David Big Knight, I think, wrote a book a while ago that got me into like, oh, indexing, they're buying a call option, and it makes a lot of sense. Whereas whole life, all the money is just really built into their general fund. And so the benefit of of IUL is you're getting upside with no downside risk. Now, yes, you and I would both say if it gets zero, there's still internal cost to that.
Of course.
And if you don't overfund it, like majority of people out there, any life insurance, whether it's whole life or IUL, will underperform mainly because of the internal cost. So this is in my research, you guys are, and I don't have to disclose the company that you're working with. I don't know if that's a public.
You work with a bunch of them, so it doesn't matter.
Okay, so you're working with one company in particular, but I'm sure you work with multiple to do the strategy. You overfund and you do what's called hyperfunding, where then you take out a loan in the year 3 and on, and then hyperfund it, so put it back into additional policies, or the policy has the ability to put more into it. And the whole concept is that arbitrage. You use the word leverage. If you can pay 4 and make 6, that's a beautiful day, because not only are you getting the power of indexing, but now you're getting the power of arbitrage. And that's what you would say is the biggest difference between that strategy versus plain old IUL. And then plain old whole life is like that's like the minor leagues where you're taking IUL and taking it to the next level. Am I mischaracterizing what you guys are doing? And is there anything that you want to add to that?
Yeah, obviously hyperfunding is when, that's a no-no word. Because that is when you stop premiums and you use the loan feature to make your premiums for you. I don't believe in that, because if you believe your product is good and you can make that 6 to 7% average, plus you can make a 2 to 3% spread on the participating loan feature, now you're building, if you have both of them working together, not just one, but both of them working together, you have created a life insurance contract that can potentially earn double-digit returns inside the same policy. We don't buy multiple policy. That's all complicated. We built a really simplified, automated strategy that your only job is to put money into it and everything else happens by itself. And so, yeah, we make that assumption over the history we have that we're going to make somewhere between 6 and 7% pretty securely. Obviously, there are costs and stuff like that. But when you do the last 25 years, even with .com 2008, the low bond industry, all the different things that go along with an IUL, we've been able to average 6.87% over the last 25 years, assuming a 10% cap. So a 10% cap is really low according to a bond that's making 1.752%, somewhere around that range. And so we're feeling pretty secure about the 10% cap range. Then when you take the loan, the leverage feature, real estate guys have been doing this forever. They buy one asset, they get a loan against it, and they go buy more appreciating assets. I just said, hey, I like that idea. Let's use inexpensive money, buy appreciating assets. But I want to do it much more simple because not everyone is cut out to have 6, 10, 15, 20 rentals. Totally. So let's build a program where someone who doesn't have time or just likes the 9 to 5 and goes home and plays with their kids and have their best life also has the ability to take advantage of leverage in the things that typically only rich people have advantage of. So.
Right. One thing I like to say about real estate is it can be an amazing asset because you can use leverage. It can appreciate, it can create cash flow, and it has some amazing tax benefits. And what you've really done is you said, all right, we're going to take the leverage effect, maybe minus the cash flow, but we're going to get the appreciation. We're going to get, life insurance when set up and used properly has some of the greatest tax benefits of all time. And so I'm all about what you guys like. I'm all about life insurance. I think where I'm concerned is it feels like it potentially could be built on a house of cards because it all sounds amazing. And your calculator is incredible, by the way. Like you type in, but it's like, man, what happens? What happens if the insurance company stops this? What happens if interest rates go down? What happens if and when the market doesn't perform? What happens when the company shuts down? Because that's, as you know, like a lot of companies are getting sued for like aggressive schemes like that. And that's where I go, like, I'm with you on the math. I think the math is brilliant. And I'm young. I've only been doing this for 6 years. I've had mentors who pretty much say, Caleb, the biggest mistake people make in this space is they make assumptions that their widget, whether it's an annuity, life insurance, this real estate investment is like the end all be all. And that's where I get concerned because I always grew up that life insurance is not an investment. And it very much feels like you're selling it like an investment. And that's where I'm like, okay, where are, like, my critical mind's like, I love the mindset. Where are the mosquitoes here? Where are the places that this could unravel? And if they do, is it just going to perform worse or is it going to blow up in someone's face? Because we all know that there has been IUL that have, now this is more like 20 years ago, but have not just not performed, but have blown up. And like that, like God forbid, that would be horrible. And I know in just doing my research that you guys have a lot of checks and balances as it relates to that. And from day one are making sure that you're monitoring this so it's not going to blow up in someone's face.
Yeah. And full disclosure, there's never been an IUL that blew up that was max funded. Okay. They're designed to, we run calculations and it literally takes 70 years. If you fund these things like you're supposed to, which I only design max funded contracts. If you're not willing to max fund a contract, you're not an MPI plan. You can't do it. And then after the second year, as we use the relock and things like that, the participating loan, it allows people to be flexible after the second year. But there are some assumptions we make. The first assumption is that the bonds market, the good thing is everything that MPI is built in, the world is built in. If the bond market fails, so does whole life, because that's where the majority of all general fund accounts inside of insurance is inside the bonds market. So does the retirement community suck because the 4% rule is built on bonds and things like that. If the bonds market can stay consistent between the 2 and 4% like it traditionally has, then that is where the S&P 500 comes into play, which we have 150 years of the S&P 500. If the S&P 500 completely failed, as you know, we get a 0 1 year, then it bounces back. We don't care. So I have run MPI in a 2% bond scenario with the Great Depression, 15 years of 1929 to 1944, and it produced less. It didn't produce the 12, 13, 14% income. It produced 7, 8, 9% income, which is still dramatically more than the 4% income. So when I go and compare it, are there Armageddon scenarios there? Yes, that is the case. But when you look at probabilities of success, and you run it again side by side. And for funny little story is when I presented this right at the beginning in 2014 to the insurance world, they told me that's impossible. There's
Right.
no way you can create a life insurance contract and get double-digit returns. It's not possible, Curtis. And I go, there is one way to do it, and only one way to do it that I'm familiar with: a max-funded IUL that uses the relock, the participating loan, to put it back in to double your contributions, not replace your contributions. And they're like, can't work. 2 months later, they call me up. Their actuaries, from Harvard and Yale and stuff, are trying to break this thing. And they go, holy crap, it worked in every single scenario we ran it against. There is no scenario, at least in current modern data that we have, that it didn't function in. I go, yeah, because you have enough security. It's not perfect like a whole life security, but you have just enough security that down markets don't devastate you. You have just enough upside that the market is making 6, 7, 8% for you on average. And your loan feature is just low enough, that 4%, where you combine all three of those together, it produces a pretty awesome result in nearly every single market scenario that you can imagine. If the bonds market went to zero, we are all in trouble. But the insurance, as you probably know, it hasn't always been in bonds.
Yeah.
So the insurance world would adjust in 1 second. They need their general funds to make 3 to 5% regardless. So they would adjust. And that's all an IUL is. Money goes in the general fund. Whatever the general fund makes, that determines your cap. The general fund's making 5%. Our caps used to be 15%. General fund right now is making 3% or whatever. Now it's at 10%. So it's always going to range, in my opinion, in that 10 to 15% range, because the insurance companies are not stupid. They're the smartest people in the whole world. So when I want to bank on who's going to win this long-term race with volatility and inflation and stuff like that, my bet is on insurance, because they've been able to be profitable in the Great Depression, 73, 74, .com, 2008. They're probably the only financial institutions in the whole world that were profitable even in the worst case scenario. So that's why I go, hey, is it perfect? No, nothing is perfect. But the probability of this succeeding when you have 3 key features: a floor, a good rate of return based on the S&P 500, and a low cost leverage, when you add those up, the probability is very high that it's going to succeed.
There in the past, IUL companies have, just like a lot of whole life companies, have different blocks. When they come out with a new product, they have different blocks. And there has been companies that have changed the cap rates and crediting and features on the other products when they get a new product, which seems incredibly misleading. And there have been critics out there that have said, all right, one thing, like, cap rates are coming down on IUL, and they're not even being truthful, because the people 10 years ago are getting screwed because they're getting less. Is that true? Or is that like something that you guys are watching? Because obviously insurance companies, and this is one thing I'll give IUL companies, you're like, they want you to stay competitive, because you could move your money elsewhere. There's provisions that you could transfer to another company. So it's like, obviously everyone wants to win and serve people well. My biggest fear is, as interest rates decline, as we potentially live longer, insurance companies, the yield is just going to get harder and harder. The ability to buy a call option is going to get smaller and smaller. That's why the caps are coming down. And it's just, when we build our whole strategy on life insurance with leverage, it's not going to turn out the way that we want it to. Maybe not because life insurance are stable. It's just not going to be optimized. Any concerns there? And how are you guys working around that and making sure that your clients 5 years from now are going to be getting the max returns that the new clients are getting?
Yeah, that's the only thing that controls an IUL is the cap. If someone goes, what is the flaw to an IUL? The cap.
Yeah.
The costs are super, super low. People like to talk about the cost, but they're decreasing and they end up a very small percent long-term. So it's not the expenses inside of a life insurance contract like Dave Ramsey and other financial advisors like to say. It is the cap and the cap alone. What's amazing about MPI is we address that. We do an assessment and an adjustment and a modification to the contract every 2 years. Okay. So every 2 years, we are going to look, what is the highest caps we can get? Where are we at? So if there are scenarios, my brother had a IUL from 2005, and the cap started off at 12 or 13%. And now it's 8% because those blocks of businesses, they what's the right word? They over committed to something. They oversold because
Yeah.
it was so new. Every new product has their flaws for the first 10 years. They didn't calculate them correctly. They weren't expecting bonds to go down to 3 or 4 or 2% sometimes, things like that. We had, 50 years of bonds somewhere in the right range outside of the 1980s, obviously. But, bonds are right in that 4 to 6% range. And then .com happened, and there are a lot of things that happened. And so what's nice, the companies I work with, and you know which company I'm referring to, they are probably one of the most conservative grandpa insurance companies. They have one of the lowest caps, but they say our cap is as strong as it's going to be. We're not promising bonuses. We don't do persistency bonuses. We don't do multipliers. We have no bells and whistles. We are going to perform. We're not going to, everyone else can say, oh, we're 15% caps. Well, guess what? I'm a 10% cap, but our 10% cap is done by conservative actuaries who want to overpromise or underpromise, overperform, maximize that. Hey, we're going to give you something, and we've been around for 110 years, and our reputation is way more important to us than making an extra buck. And so that's why people go, well, why are your caps so low? Because we're more conservative. I want to make sure that we get where we're going to get, and we don't mess around with stupid persistency bonuses and multipliers and stuff like that.
This is my next question is not a question that I came up with. It's a question that I've heard from someone else. And again, I'm a fan of I'm not just going to let them say that without getting a check from you. Life is not the company that you work with. They have been sued. They've done some scammy stuff just in the space. And what I've been told is that the only insurance company that will approve what you are doing is the one company that you're working with. And all the other companies don't even want to touch it, not because the math doesn't work, because they're afraid of the insurance commissioner coming after aggressive marketing, people getting in. Some people call it premium finance for the poor that can't qualify for premium finance. And you could see why they're doing that, because you are using leverage. And I'm a fan of this framework called value leveraging. If you want to become wealthy, provide value and maximize that value. That's every wealthy person has done that. And you've provided value at scale as well. And that's why you make more than the average person. My fear is, what is your response back to that when people are like, no company will touch you. You have an insurance commissioner that might come after you. And there's no claims as of right now. It's just aggressive marketing. And that's one thing that's concerning is if insurance companies who are dying for our premiums, why are they not embracing this? Or are all those things that people are saying just not true?
Oh, I mean, we have 2 companies, so it's more than one. And we talked to many other ones, and almost all of them said the same thing. We don't like to be the first. We're going to see how this plays out. Yeah. As soon as this starts doing, and now that we're 3 years into it, full marketing and full everything, more knocks are coming on the door I guess it does work, but it is aggressive. When you start saying premium finance for the normal person, that scares away commissioners. That scares away, whoa, you're leveraging? Oh, what else? And, we have lots of talks with the NAIC. We have lots of talks with insurance lawyers. We have lots of talks with individual state regulators and things like that. So we've done our due diligence. We're not the guys. I don't hide. A lot of people have these secret deals, and they won't tell you anything about their product. You just have to trust them. I'm the one guy who says, I disclose everything. If you've read my book or watched my videos, I don't hide anything. And that's how I've approached it with the insurance companies. Here is what I do. Here's what I say. Here's the acronyms I use, RELOC and secure compound interest account, and things that help the public understand what I'm trying to do. And any questions you have, I'll answer it. And so 2 of them are say, hey, we ran it. We're not scared. It's a little scary, right? Because new products are always scary. If I'm going to represent them correctly, they're trusting that I represent them, 110-year company, in the right light, and it's gone extremely well. We have thousands and thousands of clients. We have thousands of clients coming in per month. So they're loving it. And now that we're 3 years into it, more knocks are coming on that door like, hey, how do we get our premium? And I tell them, hey, I'm not ready for that. Right. I got married and I like my wife.
Yeah. Curtis, this is one thing I will give you a ton of credit on. You do not hide. And you put out your calculator, which I'm shocked is able to be public. But I'm sure it's approved because it's you're kind of a famous person and you're putting this out and you're not hiding it. I just typed in MPI calculator. We can agree to disagree that I don't think that that's actually going to happen. I don't think those numbers are going to be true 30 years from now. I do believe if properly structured, these are not going to blow up. And it probably is. There's a good chance if your money's on it outperforming whole life Roth IRAs. I think there's a good chance of that happening if it's properly funded, if the insurance company doesn't shut it down. So I'm not like, I don't want you to think I'm like a denier. I think the
I
biggest difference is I look at Dave Ramsey and I say, man, this guy is such a hypocrite because he's like, do you think he's made his money on mutual funds and all this stuff? No, he's made his money on building business and building value. My question to you is, you're a big fan, and I've seen videos of you say like, don't do real estate or don't do other things, like MPI is the one and only way. And anytime I hear that, I go like, oh, is that really like, if everyone did that, who would be providing value in the world? And I look at you don't have to disclose how much money you've made, but it's a lot, and you're going to continue to make money. You've invested in a team, you've invested in a new building, you've invested probably hundreds of thousands of dollars into marketing. So when do you say to an entrepreneur, don't invest in an MPI or the relock and invest in yourself? Do you have an equation for that? Or how do you teach and coach people that MPI might be the starting place, but when do you instead, because there's an opportunity cost to everything, when do you shift dollars to another initiative?
Well, so I believe in business. I have 4 businesses. I am an entrepreneur. I'm a purebred. I love everything about business. But in 2014, after 10 years of building my import export business / home remodeling granite countertop business, I lost $2 million in a single day. And it was devastating because no risk, no reward. Every penny I had went back in my business, investments in that business, et cetera, et cetera. And through a bad, unfortunate investor who, decided to take all the money out of the account one day, and I had no money because all my money went back into my business. I had to start over. And that's the day someone introduced me to an IUL. It was 2014. And I said, what the heck? What do I do now? Luckily, I was 32 years old, so it wasn't the end of the world. It wasn't like I was too old to start a business. So I tell people this: you have to make money. Compound interest does not work unless you make money. Find something you love to do that brings value to people and go make the absolute most amount of money possible. But then the very first thing you do is pay yourself first. You cannot invest 100% of your money back into your business because there is a 95% probability in 25 years from now that business does not exist. There's a 72% probability in 10 years that business does not exist. And me being the prime example, I was making hundreds of thousands of dollars, some years millions of dollars, and I put every single dollar back in my business to buy a 100,000 square foot building, and new CNC machines, and 150 employees and all this stuff. And in a blink of an eye, it was all gone. And I said, if I could have just taken 10%, 20% of my net profits and put it away into a secure compound interest account, when that devastating moment of Armageddon happens in a business, which it almost happens to every single entrepreneur that's on this planet, I would have had $2 or $3 million saved up by that point in time, and life would have been okay. So I'm a firm believer. My business protection plan, I have a business protection plan, and I tell people 75% of your net profits goes back to your business to expand. You've got to be growing. You've got to be expanding, but take 25% of your money and get it into a secure compound interest account, because inevitably your business is going to blow up. And I know that hurts people's feelings sometimes, but the data tells us that. And they go, no, I need to go all in on my business. It's going to grow slower. No. Trust me, 75% of your net profits or 100%, your business ends up in the exact same point, because there's only so many variables you can control. And money is just one of the many variables of expanding a business. And so 75-25 is why I tell everyone, go start a business. I love business. Find something you love to do, then you're not working. But 25% of your net profits needs to be going to your security. So in 10 years, if you have my experience, you've got $2, $3, $4 million saved up. Okay, life's good.
Why wouldn't you put 100% into the IUL, and then instead of doing the HELOC method, you would just take a loan and reinvest it in like 75% of that portion into your business, and because you're still getting the arbitrage? Is that what you recommend when you say I put 75% back into my business and 25% saved?
Well, one of the things that MPI does different than like your hyperfunding scenario and things like that is when you over leverage, that puts you at risk. MPI is extremely calculated. When do you leverage? Exactly how much do you leverage at this proportion according to growth, so that you never exceed an over leverage. And so I am not a fan of these guys who like sell these IULs and even whole life where you put in 100% of your money and take out 95%, because you just create a 9-to-1 leverage ratio.
Right.
2 or 3 down years in a row, you're done.
So but how is yours different? Because I'm getting the sense that you're buying more cash value, essentially. I mean, I'm trying to dumb this down so you're getting more indexing power, but you still have an outstanding loan. Are you saying that every year that goes by, your outstanding loan should increase, but your cash, that compound, should increase? Is that correct?
Yes. And so when you're putting in your own money, that's why I say pay yourself first,
Yep.
regardless, every single year moving forward. And then the leverage starts adding to it. You get to a 1-to-1 ratio, you get to a 2-to-1 ratio. We never want to go back past the 3-to-1 ratio, because a 3-to-1 ratio can last 7 years consecutive down markets. The most we've ever had is 3.5. So I want to be double the worst scenario that's ever happened ever. And if you leverage slowly and let it compound on itself rather than all up front and being over aggressive, and then you have the hyper funding scenario of 2005 where people are pulling out HELOCs and hyper funding their products, and then down markets happen, and then lawsuits and all the other things you're talking about. MPI was very calculated by actuaries, by security first. Never go past too much leverage. There is a point of too much leverage. And if you keep it inside these confines of 1-to-2 leverage ratio, somewhere in that range, you can get these amazing 10, 11, 12% returns without Armageddon just 2 years down the road, those type of things. So I'm not a fan of putting a ton in and then leveraging it out. Slow and steady wins this race.
Okay. Obviously, as an analytical person, I love to see the numbers, and I've seen general numbers. Obviously, one of the potential disadvantages of insurance companies is when they do illustrations. We're not supposed to have loans in the final doc, so there's some hypotheticals. But at the end of the day, I do respect where you're coming from. What are your thoughts on Doug Andrews, and do you like his philosophy? Or I know you jabbed at him a little bit earlier indirectly. Are you guys friends, or is it one of those things that you guys have different philosophies?
I mean, he does option A, which option A is always worse than option B, but it pays 3 times more. So I don't know if he does that on purpose. He runs his numbers, and when he starts saying that your IUL is going to make 9-10% without leverage, it's like, oh my goodness, that is my beef, is when people overstate. If you see my calculator, I'm claiming 6.4. I'm not overstating. I'm just saying, we think we're going to get around 6.5. I'm going to build this calculator, and the numbers are sticker shock. I mean, they look so big, even on a 6.4. But when some people start saying your IUL is going to get 8, 9, 10%, no, it's not. No, it is not. Unless bonds go back up to 5 or 6%, that is not a possibility. But then
the 4% cost is going to
goes up to
go
5 to
as well.
6 also. Exactly. And so we're all in the same industry. So there are some things that I don't think we have to oversell insurance. I get my numbers are really big, but that's just through leverage. That's not through me overselling. So when I see insurance guys and infinite bankers and uninterrupted compound interest guys on TikTok and stuff, I'm like, dude, you're overselling. There's no need to oversell, because it's already an amazing product. I'm just using it slightly different, getting that 2 to 3% arbitrage spread, and you let that compound over 20 years. Now that is where my numbers come from, not because I'm overstating a 7, 8, 9, 10% rate of return internally.
I'm with you, by the way. I think the biggest threat to our industry is people overselling. And again, the main thing that I'm really, really critical on is, why are we selling life insurance as an investment?
And I don't, obviously, investments, in my opinion, are things that put you at principal risk.
Yeah.
IULs don't have that. So I'm more on the side of what produces retirement income.
Yeah.
Whatever the end result is, it should be focused on retirement income. I know financial advisors like say, oh, what are your fees, and what are your taxes going to be? And it's like, well, although we're tax-free income and we have the lowest fees and all the other great things about MPI, retirement income is the only thing that matters when you're designing a retirement plan. So I say life insurance retirement plans, if you want the most retirement income tax-free, there is a vehicle that can do that. I also believe in real estate. I also believe in stock market. Build your foundation so you earn the right to invest. You don't invest first to build your foundation. That's not how it works.
Yeah. Are you familiar with Dr. Wade Fowler's research and Jason Sanger's research when it comes to volatility buffers and pension maximization, the philosophy there? Because you're very critical on the 4% rule. I always like to challenge people when they're like, why is the 4% rule like the gold standard? Like, how does anyone have a job if that's the best we can do? Because it's like, that's not the American dream. If you look at the actual money that people have at quote unquote retirement, and then you translate the 4%, now they're saying the 4% is too risky. It's like, yikes. If we actually thought with the end in mind, we would think different with our money. Cash flow would come first. Here's my big concern is life insurance. I love life insurance. I love it. I just want to go on record by saying that. We sell not as much as you, but quite a bit of life insurance. But we do not sell it as the vehicle in retirement, because in just 5 years of being in business, I had mentors early on that were very aggressive using whole life and IUL, And I saw those companies totally shift. And I saw families have all their eggs in one basket. And that was one thing that I said, the math is right. The insurance power of insurance companies and the laws are right. But it's like all their eggs were in one basket. And I saw how one insurance company changed their mind and how that had a lot of effect. And so from very early on, I always were like, I like the idea of this being an enhancer. I talk about it more as an and asset. And part of the and asset is you can utilize it for income. I just think you're very vulnerable long term if all your eggs are in one hypothetical example where, yes, you're right, the math does work, but what does happen if something changes? And I've seen how a little changes can really have a big effect. And you kind of answered that by saying that you do believe in diversification, and maybe someone shouldn't have all their eggs in one basket, even though the math looks good. 6.4% is very conservative. My pushback to that is, what happens if you don't get 6 and it gets 0 one year? And so that the average rates of return versus the consistency, there is a difference there. Any thoughts on my maybe not so clear question, more of a rant?
Yeah, well, everyone inside of an MPI plan, you probably know you have a max insurability. You can only get so much insurance. And so like I maxed out. I'll be honest, I put in $1.5 million per year into my MPI plan, but I make a little bit more than that. And so where do I go after that? I've got to go find investments, but I've earned the right to put myself at risk. I've earned the right, because even if the investments blow up, which are more probable than my insurance contract, I still have a foundation. And so we have a thing called the conservative risk taker plan. And that is when you hit max insurability, where do you then use the participating loan to get other things? Or when do you use your money to go get into real estate or REITs or things like that, that you can also have multiple buckets? I always say max fund your security blanket first, and then go find things because you've earned the right to invest. So yeah, I mean, there are so many places to earn money. I put money in a guy who guarantees me 8% on a real estate portfolio and all stuff. And it's just an income fund money. You know, I have nowhere to put it. So it's like, okay, here, give me 8% per year and I get my principal value guaranteed. Okay, cool. Let's do that stuff. But that's not a retirement plan, because that can stop at any given year. I can get my principal back. And then what I do, you talked about the 4% rule, and man, my first book was called Everyone Ends Up Poor. My first best-selling book, Everyone Ends Up Poor, because no one is taught that these investment plans aren't retirement plans. Your 401k, your Roth IRA, your IRA, they are not designed with retirement income as the focus. They're designed as net worth as the focus. So that hey, you got a big nest egg. I got to the elusive $1 million portfolio that 1.6% of all the population ever get to. And that still only produces you around $40,000 of retirement income. No one tells anyone that. And by the time you find out, it's too late. And so my thing is, hey, probability of your 401k producing a lot of income or MPI producing a lot of income, my money's on MPI. And it can produce maybe double, triple, quadruple the amount of money that a 401k with the exact same account value. They both grow similar. So by the time you get into an S&P 500 index fund over 30 years, it's going to grow at about 10 to 11%. MPI in the same 30 years is going to be 10 or 11% on average, collectively, side by side. But one slows down as time goes on. I assume you know how the 4% rule works. You're a lot of stocks in the beginning, very little bonds. And as you near retirement, your sprinter mentality to make money slows down to a walking mentality. Got to go buy some bonds now because I got to be secure. Where MPI accelerates as time goes on. So your highest rate of return is when you're older, where a 401k IRA, your lowest rate of return is when you're oldest. And your rate of return in retirement is your income. So you should only be focusing on one thing and one thing only. What produces the best long-term result? And if it's not focused on long-term result, you got to reconsider. There are a lot of things out there, leveraged real estate, leveraged life insurance, a few other things that focused on long-term. Everything else is a pretty amateur at best retirement plan, but that's where all the money is because it looks so good early. You can make a bunch of money early in stocks and things like that. And people get tricked by, yes, I feel really good by getting a home run today, even though it's going to be a strikeout when you get to retirement.
Yep. Curtis, is there anything else that you want to say about any questions or any tough objections that people throw at you? Because I think one of the biggest things is if you don't understand the power of life insurance, this is really hard to understand. And obviously, thanks to 7702A, it's there's some amazing tax benefits to life insurance, and I'm a big fan.
Especially with them adjusting it this year.
Yes.
Now it's even more amazing.
So, and that, you can touch on that. Is there anything else that you want to touch on? Because I think, obviously, I'm not a believer in what you do. And I have a lot more respect for you by coming on, explaining. I'm glad that you are being conservative. I just don't have a belief in this structure over 30 years because of insurance companies, because of all the factors that you and I can't control. And I think there's a lot worse things you can do with your money, and that includes 95% of where people are putting your money. Because I think putting your money in a 401k, deferring to an unknown date where who knows the tax rates, who knows what the markets are going to do. Like, so I'm not saying like it's just one of those things where that's where I'll just be honest with. But I think there's a lot of worse places you can put your money. And I think the way that you articulate yourself and hold yourself and the team that you've built is impressive. And I think people can watch this and maybe feel way more confident on whatever decision they're going to make.
Yeah, I mean, ultimately in 15 years, we'll 1035 your old contracts into a good contract, because at that point in time, we'll be 20 years into it and you're like, oh, it did work.
I'll come on board and be
work.
like, hey, dude, you have a sales position. I want to come on your team.
But even this, when you compare it to other strategies out there, why not take 10% of your assets and put it into something that potentially has this type of long-term asset, long-term retirement projections? Because like you just said, diversify. If you have your money in whole life and some in an IUL, there's no point in having an IUL without leveraging it. Whole life, I get the whole life thing because you get the guaranteed dividend and things like that. And there are some benefits as a death benefit play and things like that. But if you have an IUL, there's no reason to not leverage it, because it's either going to blow up because the whole thing collapsed because insurance just lied to you the whole time, or leverage is going to work.
But leveraging, I feel like leveraging increases your chance of it blowing up if with insurance risk, like cost of insurance, cap rates, like you're not doing it to the max, but aren't having an outstanding loan creating a potential probability of that. Like who would be more safe from it blowing up? Just funding it with no leverage, obviously that's boring. Or your strategy with leveraging it, I feel like if everything hits the fan, you're going to be the first one to topple over versus the plain old vanilla overfund with no leverage.
Well, the good thing about MPI is there's always an exit strategy. See, the loan feature is additional premiums inside your plan. There's an exit strategy if this thing ever got to a point where the 4% loan rate, or whatever the loan rate is at the time, it could even go lower now because interest rates are so low. At any moment in time, you're not in an average arbitrage spread. Some years are going to be 0. We know that. Some years are going to be 10. We know that. And, but if there ever gets to a point where that average return is less than the loan rate, you exit it and go back to a max funded IUL. We've crossed all these T's and dotted these I's saying, what happens when this happens? And we need to have a solution for that, because people are trusting us. People are building a plan that is supposed to last for the next 50 years of their life. And so we've gone through every scenario, every iteration that we can think of, like, okay, what happens here? What happens here? And ultimately, a regular IUL, if you max fund and everything, it takes 7 years to blow up. But the income is, if you're using a supplemental income, then it does exactly what it's supposed to do. Whole life barely keeps up with inflation, but it's an inflation-proof bank account. Okay, that's exactly what it's going to do. If you want to compete with the stock market, if you're already going to have money in the stock market, you might as well have it somewhere that has the guaranteed security and the tax advantages and the life insurance, all stuff. So it's more of that, hey, if you can accept a little bit of this extra risk because of the market and the environment and things like that, and there's already $26 trillion inside the 401k, there's a much better place to put that 26 trillion with a lot of additional features and benefits. Is it perfect? No. Yeah. But does it give you a high probability of success? The answer is yes.
Yeah. Ted Benna, the guy that discovered the 401k I've had on the show, and he said he's number one. He's created I don't think he potentially said this, people put it words in his mouth, he's created a monster, but it's really where he's very disappointed in is the income side and just the lack of understanding, and then a lot of companies are deferring all their responsibility to a third party 401k, and we really do have a disaster on our hands. And I think it's people like to point fingers, and it's so easy to do the blame game. But at the end of the day, we need to take responsibility. Going back to the richest man in Babylon, the biggest epiphany that I had was you have to pay yourself before you pay other people. You have to have that conviction of paying yourself first. And when we look at Barry James Dykes just spoke at one of our workshops, and he said that the national savings rate is embarrassing low. It's less than 5%. And now maybe with COVID that increased a little bit, but it's you can't get ahead regardless. I don't care where you're going. If you're not saving any money, you're going to get destroyed. And unfortunately that's what we're seeing in this world. And so I commend the message of paying yourself first, talking about compound interest, that energy, dude. It's no one can deny that you're not passionate about what you do. And there are
I
people
believe in
that
what I'm doing.
there are
And
people that are saving that wouldn't be saving because they watch one of your TikToks. And for that, I am very, very, I commend you on, and I'm hoping that we can stay in touch, man, because it's going to be exciting to see the brand that you continue to build. And if there's anything that I can do, I'm always open-minded. And Dan Thompson was one of the books that I read on my journey, and I know that he wrote the foreword or something to your book. And so I know that there's some mutual friends in the space, and time will tell.
We're all on the same team. We're all on
Yep.
the same team. We're trying to help people. And, there's this article written by, I think it was Forbes or Yahoo News, that says someone needs to come out with a solution to retirement income because nothing's designed for retirement income. And I'm like, hey, I'm at least trying. No one else is trying. Everyone else is about asset preservation and lowest taxes and lowest fees. And no one's trying to address that there's a retirement income Armageddon coming, like that is going to look really bad. And I'm out there saying, hey, what I've created gives you something that security, which you need, a good growth potential in the S&P 500, which you need, but those two are not good enough. In a whole life, it's not good enough. IUL is not good enough. Real estate, it's not good enough. You have to include leverage. And I know leverage gives you a little bit more risk, but you've got to include that if you want to achieve the retirement you want in less than 40 years. Like, we've got to be doing this in 2025.
Yeah, and our framework for helping people is, number one, know thyself, know what you really want, because it's a shame to go through your whole life and not ever live to the life that you were designed to live. And so I know that sounds woo, but it's like we spend a lot of time figuring out what our clients really want. If money wasn't an issue, then we go into what are you currently doing, looking at your cash flow, look at where your money's being saved, look at where your money's being consumed, and saying, what are the inefficiencies there? Then we're saving is so important because that's the verb of paying yourself first. And then from there, it's where can you best maximize your wealth, your money. And we measure everything from cash flow, because instead of retirement planning, we should call it future cash flow planning. And we have some clients that double down on IUL because they have a belief that it's like, I don't really want to invest in myself or other things. I want to put my money in an asset. I understand the potential risk, but this will give me the best upside. It has good tax advantages. They understand. But we also have a lot of clients that save their money into life insurance and decide to use leverage in other things. But I would say one of my biggest frameworks is value leveraging. Learn how to create value, whether it's with your time, your money, your relationships, and maximize that. And if you're not going to do that, you will be a very happy broke person. And so it's just, I think our biggest difference is I'm not a big fan of leveraging and then investing back into an insurance product. I see it more as a place to storehouse money and save money and have it be an and asset. And I think you're seeing it as an amazing foundation to leverage back in. And I understand where your math is coming from, and we will see what the future holds. But again, you're not going to go wrong by helping people save money. And so I think we're very much aligned for the most part of what we teach. And if I could communicate half the way that you do, I'm going to have a bright future.
You're very good in your videos. I'm like, dang, I wish I was as good as looking as him and could speak as well as him.
Bro, is there anything else that you want to end? I do want to end this podcast with my legacy question. It's not going to be money related at all. Is there anything else that you want to say? Obviously, compoundinterest.com is the website that you guys are going to probably be doing some crazy things on. Is there anything else book-wise? I do want to be a platform that benefits you.
Yeah. Well, compoundinterest.com is a complete video series. So I have two books, Everyone Ends Up Poor and The Lost Science of Compound Interest, but very few people like to read. It is 6 hours of content between the two books, maybe 7 hours. So over the last 6 months, we condensed those two books into a 2-hour video series, 16 videos broken up in 5 to 6 minute videos about every topic you'll ever want to know about life insurance and how MPI works and how the leverage works and things like that. So, and it's free of charge to every single person. We don't ask for anything. You can just go on there and watch them direct. So if you have interest in learning why the 401k IRA are not your best solutions, in my opinion, B, what the value of life insurance can bring to you, whether it's just an IUL or leveraged IUL or even just life insurance in general, go on there, compoundinterest.com, spend 2 hours, get lost. You're going to spend 2 hours on YouTube and TikTok anyway. Might as well put it to value and increase your knowledge, because financial literacy is the key to financial freedom. You cannot achieve financial freedom long-term without knowing how the game is played.
Biggest asset You or life insurance?
Well, life insurance can't get any money if I don't work my butt off and bring value to other people. Because everything, if people go, well, I have 4 businesses, and people come to me all the time and say, Curtis, oh, I want to start a business. I want to be successful like you. And I'm like, it doesn't quite work that way. But if you want to start a business, there's only 2 things you really need to know. One, can you bring value to other people? I don't care what your product is. Oh, I create this product. I created umbrellas in Arizona. That doesn't bring value to anyone. And B, love what you do so it never becomes a drain on you. Because
Yep.
I work 12, 14-hour days, and everyone's like, you work so much. I'm like, I'm already retired. I do exactly what I want, when
Yep.
I want, with whom I want. I fly to Tampa to go to a football game. I fly back here. I go to Hawaii because I can always do what I want to do at any moment in time. So bring value to other people and love what you do. And you combine those 2 things, wealth is in your future.
So last question. It's called the legacy question, and I'm going to cut out something for you because I'm going to give you a kind of guidelines on how to answer this. So this is your last day on Earth. You're with the people that you love the most. You can't give them any book or any of your videos, and you can't talk about compound interest, which I know is going to kill you. What are you going to make sure to say in that last conversation to your family and to your loved ones in all the things that you learned in life? Like, what do you want to pass down in that last conversation?
Enjoy the journey.
Enjoy the
Everyone
journey.
wants to suck on their life, like, oh, I hate my life. I hate this. Depression is rampant, all those things, because everyone forgot that this is a journey. There's no finish line. The
Yep.
finish line is you die. So you've got to find something today that you enjoy, and enjoy the relationships, enjoy the people, enjoy your job. Even if you don't like your job, find a way to enjoy it, because the journey is the only thing that matters. We die with memories, experience, and relationships. So find a way to enjoy the journey, and everything else will work itself out.
Curtis, thank you. Thank you for coming on the show, and I appreciate your answers, and I appreciate your commitment to enjoying the journey. Guess what? That can compound because people can see that enjoyment, and that has an impact. So thank you again, and I'm sure we'll be in touch soon.
Thank you. Talk soon.